I'm Robin with Vibrant Future. I'm a capital advisor and I help business owners plan and secure loans for their businesses. Today, are recording a series of videos that go over some of the key basics about business loans. In this first video, Loans 101, we'll go over the different types of lenders and loans and how they can be used. In our next video, we'll go over the differences between when a loan can be good for your business and when can it be bad. The third video covers what it takes to get a loan, and in that video, we'll go over some of the key factors that lenders consider when approving a loan, as well as how quickly you can expect to get a loan. And then finally, in the last video, we'll talk about some of the common fears and misconceptions that business owners might have about getting a loan. This video is intended for businesses who might be actively seeking a loan, as well as for a startup who may not yet have opened their doors for business, but want to make plans today for the possibility of getting a loan and increasing their odds for securing future capital. I also want to emphasize that while this video might be appropriate for any businesses in the U.S. Operating in the United States, this video is really being prepared specifically for those located in Portland, Oregon, as we will be referencing organizations and other resources specific to the Portland area. And finally, I want to give a big shout out to Prosper Portland, who is supporting us in the production of this video, as well as all the other videos that you see on this channel. So with all that said, let's get started. So the first question is, what is a loan, right? You may know this, but let's break it down. A loan is really capital from a third party that can be invested into your business. And so common uses for a loan include purchasing assets, such as equipment, vehicles, real estate. These are all assets that you can use as part of your business. It could be used for making investments to grow your business. It could be tenant improvements. You've gotten a space, you're looking at a space, and you need to configure it, build it out to meet the needs of your business. You could be making investments to hire staff or do marketing to generate sales and additional revenue for your business. And it could be for providing working capital. You know, working capital often has multiple definitions, but essentially it's the money, the funds that you need to make your business operate, make it stay afloat. You know, you have expenses, you have income, and sometimes your income doesn't align nicely with your expenses. You might have to pay expenses upfront. If you're a manufacturer, you have to buy the raw goods, raw materials. You have to go through the effort, pay the staff to build, manufacture your product, and then it takes time for you to sell your product. But it might be days, weeks, or even months before you get revenue from your clients. And so that capital that you use for building and maintaining and storing your inventory is what we often refer to as working capital. A loan also has an obligation that comes with it, and you're obligated to repay the loan, and typically with interest and fees attached to it. So unlike an equity investment where an angel or a venture capitalist might make an investment in a company, and in return they get a share of your business, they have some ownership in your business. A loan, the only obligation is that you repay the loan. The investor, the lender, does not have any stake in your business. You have free reign to operate, the business as you see fit, but you have the obligation to repay the loan along with interest and fees. A term often associated with loans is default. It can be a scary word, but basically default means when you can't meet the obligations of the loan. A loan, the main obligation is to make the payments. Typically, a loan has a payment, oftentimes the monthly payment, and you have an obligation to make those monthly payments. And if you can't make those payments, if you become delinquent or you stop making those payments, you are in default or non-compliance with the loan. And when a loan is declared in default, the lender has some recourses available to them to help them recover their funds. Defaults don't only happen when you can't make the payment on the loan. There are often other obligations associated with the loan. Maybe you have to generate a certain amount of profits. Maybe you have to operate, continue operating your business in a certain district. Whatever, lender will at closing define and identify and define other obligations that you have to fulfill the terms of the loan. And so if you're not able to produce or deliver on any of those other obligations, they can also, declare a default. And we'll go into this a little bit more later in one of the next videos to talk about, what may happen when you're in a default. And then another common term associated with loans is security. And security is, recourse. It's what a lender can do or have access to when you default. And it could be a collateral. Collateral is an asset. Typically, it's a piece of equipment that you agree to hand over to the lender if you default. And then the lender will then sell that collateral, and the proceeds that it gets is going to pay down your outstanding balance. You may have a personal guarantee, and in fact, every single loan has a personal guarantee. And I often come across businesses who say, "Oh, I want a business loan, but I don't want a personal guarantee." You won't get a loan. Every single lender will want a personal guarantee. And what a personal guarantee means is that in the event that the business can't repay the loan, they want a personal guarantee from each of the owners. And an owner, for lending purposes, is typically anybody that owns more than 20% of the business. They want each owner of the business to personally guarantee that they will fulfill the loan. So if you default a loan, the business shuts down, there's no more collateral, and you still have a balance that's due, the lender can, with a personal guarantee, pursue you, the individual, to make good on the loan. And again, we will have some examples to kind of walk through that in one of these upcoming videos. They could have other things like liens. Liens are kind of a protection, typically associated with a large asset like real estate, or even a car. And they can put a lien that basically says, if you're going to sell this asset, liquidate this asset, you must get our permission. And implicit in that permission is that if there's any outstanding balance that's owed on the loan, that you repay them before they release or authorize the ability for you to transact that asset. So there are many others, but those are, some of the typical security elements that are built into a loan. Let's also take a moment and talk about the different types of lenders. There are many, many different types of lenders. First, by far, banks and credit unions. They have the most amount of capital that's out there. They get their money primarily from depositors, and those funds are then can be used for lending out. And they lend out the money, they make interest, and that's how they make money. And that's not a problem. This is America. You're in business to make money, just as banks are in business to make money. So banks and credit unions are by far the biggest lenders here in the United States. However, because they get the money from depositors, because they have to make good on their deposits. So if you put $100 in the bank, in your checking account, you expect to get that $100 back at some point, whether it's tomorrow or it could be 10 years from now. You expect to get that money. So in order for banks to fulfill that obligation, they're regulated in a way that doesn't allow them to make too risky of a loan. And unfortunately, what that means is that not every business can get a loan. Some businesses, as deemed by the banks and the regulators, may be too risky to extend a loan to. And so that's why there's a whole bunch of other lenders that are out there. There are community lenders. These are typically nonprofit organizations or government agencies. Sometimes they're referred to as CDFIs, or Community Development Financial Institutions. It's a long word, but basically these are organizations that lend for a purpose, for a mission, whether it's to support economic development in a certain area, whether it's support a specific industry, Maybe it's to support a particular demographic. There are many CDFIs out there that primarily support minority or BIPOC-owned businesses. They all have they're all nonprofits, or typically nonprofits, and they have a purpose, they have a mission, and because they get their money from other funding sources, they that accept and tolerate the risk, and those funders know that they're making these loans for a specific purpose. They can be more flexible in making loans to certain businesses. I used to run a CDFI, and we were able to make loans that banks couldn't loan because we didn't necessarily need to make a profit. Now, don't get me wrong, we want our money back, but we are not motivated by making a profit. Our funders acknowledge that these loans can be more higher risk, and so we're not regulated. We're not required to have certain risk profiles that meet the more conservative requirements of bank regulators. So in Portland, we have organizations like MISO, Craft3, Business Impact Northwest, even Prosper Portland as a government agency is a what I consider a community lender. At the state level, there's Business Oregon, and they make loans for economic development purposes in the state of Oregon. So you have community lenders. They have typically have a lot of capital, but they don't have their capital that's available to them is a drop in the bucket compared to what banks and credit unions have. Another source of capital that you may want to consider is suppliers or sellers. If you're buying a piece of equipment, oftentimes the seller will finance either directly, or maybe they'll partner with another lender and offer a package deal, to help sell their products. And sometimes though you can get a pretty good deal. They maybe are willing to put together attractive financing, lower interest rates, a simpler application process, all for the purposes of selling more goods. You see this often with cars. There'll be an incentive that a car dealer might be saying, hey, for the month of April, we're going to offer 0% financing to qualified buyers. Again, that's an incentive and helps facilitate some sales of their vehicles. So if you're considering buying equipment or any other large assets, definitely ask the supplier or the seller if they're willing to or able to provide financing. And like I said, sometimes it's easier, sometimes even cheaper to get financing from them. Another example, when I used to have a business, and it was a media company, and we had a huge printing bill every year. Initially we thought about getting a loan from a bank to help cover that cost, but we were able to work out a deal with our printer, which is our supplier, and this is like a $1 million bill that we had due. And they gave us very generous payment terms. They gave us, I believe, up to 6 months to pay them, pay their bill in various installment plans. And and they didn't charge us interest, or they built that into the price. I don't know. I don't care. But that allowed us to operate our business and give us some cash flow flexibility. I didn't need a business loan. I got the financing from the printer, and that was tremendously helpful for my business. So if you are dealing with suppliers and you have good terms with them, and you've been reliable, you're making reliable payments, definitely talk to them. See if they're willing to extend some more flexible payment terms, and that will give you some cash flow relief, for your business. You can also go to your customers for financing. And, that's oftentimes you see it in advance of crowdfunding or advances or purchase payment plans or membership. These are all kind of scenarios where you give some incentive for customers to give you cash up front. And maybe it's a discount, maybe it's a perk, whatever it is. but they give you the money up front or pay you in advance of when you incur the costs. And that's another type of, essentially financing. Again, you usually have to offer some type of discount or perk, but that might just be a cost of doing business. And there's not really any application or paperwork to fill out. So it's, if you have something compelling, it's a pretty form of financing that you can get. There's also industry partners. There's just lots of industries where bigger players in the industry, they want to, support their suppliers, or partners. They want to, nurture the growth of their industry. And there are occasion some industry partners that will extend favorable financing terms to other members, smaller businesses, upstarts, startups in their business, in their industry. So ask around. If you're, in a particular industry, ask peers, ask competitors. If there's other industry partners that might be able to provide some financing. And then the last type I'll talk about is, online alternative, sometimes referred to as hard money lenders. They're out there. I've known lots of businesses that, go after them and use them. Just be wary. They make it really easy for you to get capital. Typically, very few forms. They really make it easy, but they can be very expensive. I've seen effective interest rates upwards of 100%. So that means if you were to borrow $1,000 today, a year from now, in order to repay the loan, you have to pay $2,000. That's very expensive. They sometimes also come with very onerous payment terms. Oftentimes they'll say, every business day, we'll deduct a small amount from your bank account. And, it's a small amount, and initially it doesn't sound too much, but during your slow seasons, that small amount could make a huge difference in your cash flow. And I've seen many business owners, when they're in a tight spot financially, they're spending 90% of their time or more scrambling to find out how they can get cash instead of running the business. And that's not a good place to be. I also know that some businesses have done well with them. They've done their homework, they did the math, and they decided it's worth it to them. So I'm not saying they're all bad, but do your homework, be wary. Definitely look at the fine print and make sure you understand, what you're getting into. I have another video on this very specific topic. It goes into this in much more detail, so I would encourage you to, watch that video if you're considering getting one of these, quick 48-hour loans. All right, so we will now talk about the different types of loans. There are really two types of loans. There's term loans and lines of credits. Term loans is in which you borrow the cash upfront and then you make periodic, typically monthly payments over time. And so good examples of a term loan are an auto loan or a real estate mortgage. With an auto loan, let's say you're looking at a car that's $30,000, you can put down $10,000. You need a loan, a $20,000 loan to finance the difference. So you borrow the money, an auto loan, you borrow the $20,000. And then for the next 5 years, or whatever the term of the loan is, you make, several $100 monthly payment. That's a term loan. Mortgages work kind of in a similar way, except it's bigger amounts and typically much longer terms of the loans. But those are good examples of term loans. And for businesses, term loans are very handy when it comes to purchasing a piece of equipment. They're also good for tenant improvements. Let's say you identified a space that's great for your business, but you need to invest $20,000 to build it out, to install certain machinery, to add lighting, add signage, whatever the case. You need to make tenant improvements to customize that space to the needs of your business. So term loans can be used to finance that, and they can also be used for general expansion. Let's say you want to launch a new product line or enter a new market, and you have to hire staff or buy more inventory, or make an investment so you can produce your goods at a lower price. Whatever those cases might be, you need that upfront cash to make that investment so you can expand and grow your business. The other type of loans is a line of credit, and it's not directly a loan right away, but it's an access, it's a promise by a lender that says you can access this cash when needed. So if you have a $10,000 line of credit, it means that the lender is willing, setting aside $10,000 for you, and whenever you need to draw it, you can go in and pull the money out. As long as you're not pulling out the money out, you're not paying any interest. But the moment you pull the money out or draw the money, you start paying interest on the amount of money that you take out. And you can do installments. If you have a $20,000 line of credit, maybe you only need $5,000 initially, so you pull $5,000, and then a few months later you have another investment that you want to make. You still have $15,000 left in your line, so maybe you pull out another $10,000, leaving you with $5,000 left on your line. So it provides this kind of flexible, credit. And credit cards are a great example of they're essentially a line of credit. Every credit card has a limit. You can spend up to that limit, and ideally, you're making payments, over time. And maybe it's the credit cards, you have a minimum payment. Lines of credits, sometimes the lender will impose a minimum payment that they might say, yeah, you don't have to pay the balance right away, but every month we want you to pay 5% or 10% or whatever of the outstanding balance. And lines of credits are great for working capital. Those I used to work a lot with construction firms, and they have contracts, often net 60, even net 90, which means from the day they submit their invoice to their clients have 60 days or 90 days to repay, to pay the invoice. And that's on top of the fact that, they may incur costs for materials and labor and other supplies, up front. So they're carrying a lot of money, or you're required to carry a lot of money until you get repaid to cover those expenses and make a little bit of a profit. As your business grows, if you're a business like that, as your business grows, your working capital needs become greater because there's just more money that you need to float. And so lines of credits could be an excellent way of, when you're just a little bit tight with cash because you're waiting for your clients to pay you, you can draw on your line of credit and fill that gap. And then when you get paid by your clients, you can pay down your line of credit. So working capital is a great way of using a line of credit. I've also seen people use it for an opportunistic or a rainy day fund. As the rainy day fund, there might be unexpected expenses that might, happen. And that's just life. But if you have, a small line of credit, that you have some resources that you have access to in the event that you incur those unexpected expenses. And likewise, there's an opportunistic element to it. You might be presented an opportunity to grow your business, to reduce the cost of operating your business. You don't know if and when that may happen, but when it happens, you want to know that you have the cash to make that investment. I used to work with a bus company, or I provided a line of credit to a bus company, and one of their ways of managing repairs on their fleet is that whenever a similar model bus came up for sale, they would want to buy the whole bus, and that bus would then be used for parts for their fleet. They have no idea when a bus might come up for sale, but when it does, they wanted to be able to pounce on it, get it quickly, because they're not the only ones that are doing that. And so they got a line of credit, and most of the time they didn't draw on it. But when that opportunity to buy that bus for parts came, they would draw on the line of credit, acquire the bus, and then over time repay the loan. So that's an opportunistic kind of use for a line of credit. The last thing I'll say about lines of credit is that they can be a little bit dangerous. They're a little bit risky because business owners say, oh, I have access to all this money. But keep in mind, you still have to repay that loan one day. And banks sometimes, or lenders sometimes, require you to um, uh, make uh, make payments on a loan so that you bring the balance back down to zero. They don't want you to kind of pull out the money and leave it at, the max, and just let it, sit there. It's expensive to you. B, it can be used to sometimes hide losses in your business because you think, oh, I have access. I'm a little short this month. Um, uh, you know, Expenses were a little bit more than, revenue. I need to cover my costs. I dip into the line of credit, cover my costs. And you do that once or twice, or maybe on a seasonal basis. That's okay. But there are often times where there's a business that um, will rely on a line of credit just because they're consistently losing money, and that's how they stay afloat. So you need to be very diligent and manage your line of credit, very carefully. And like I said, sometimes banks or lenders, a line of credit, lenders may have requirements that kind of require you to pay down the balance, bring it back down to zero, what they call rest the line of credit. And that just helps prove, mitigates their risk, and helps you more effectively use the line of credit. So that's it for the first video. And join us for the second video where we will talk about, good loans and bad loans.